What's going on, guys? It's your boy Tyler bringing you fundamental news. Today's article is brought to you by Dow Jones Newswire. Banks are in the grips of investor crisis of confidence, head of Wall Street. First Republic's bank's seizure and sale to JP Morgan Chase was supposed to be a cathartic moment for American banks, the dormant of the financial system's latest crisis of confidence. The relief lasted for barely a day. On Tuesday, shares of regional banks were plunging, with a handful of them dropping by double-digit percentages. At one point on Thursday, the KBW Nasdaq Regional Banking Index was down 15% from the prior week, though it rallied back on Friday to finish the week down 8%. Why does this matter? Investors, after all, aren't depositors. A decline in a bank's share price has no immediate effect on its ability to satisfy its obligations as they come due. And PacWest and Western Alliance, two regional banks that ended a volatile week, down 43% and 27% respectively, reported no unusual deposit activity following First Republic's fire sale. Economist Benjamin Graham once said that markets can be a weighing machine in the long term, reflecting reality, but in the short term, they can be a voting machine, expressing what investors think will happen. And right now, some are voting against regional banks. What happened to First Republic shows that banks are uniquely vulnerable to an investor vote of no confidence. California's banking regulator pointed to First Republic's free falling stock as part of the justification for its decision to close it. The bank, the regulator said, had failed to restore market confidence in its business model. This wasn't supposed to happen. After the 2008 financial crisis, regulators and lawmakers went to great lengths to make banks safer and less vulnerable to market swings. Banks generally take less risk than they used to on their trading desks and in the kinds of lending they do. They also usually have more capital than regulators say they need. As of the middle of last year, more than 99% of community banks and all regional banks with assets up to 100 billion reported ratios of capital to assets above their requirements, according to the Federal Reserve. Few questioned the soundness of the banking system until March 8, when Silicon Valley Bank disclosed a loss that called attention to its shaky finances. Yet the problem caused by rising interest rates in banks' portfolios, a central part of this current crisis, isn't a permanent one. Banks, bonds, and loans yielding less than today's market rates, which have dropped in value, will eventually mature or pay down. That will give banks fresh money to invest or lend at much higher rates. Jefferies analysts noted that the banks they cover expect to see a roughly 20% to 80% improvement in the paper losses in their securities portfolios by the end of 2024, and that presumes the Federal Reserve doesn't change course in its tightening. Pursuing rates for an extended period or even lowering them might sharply boost the value of banks' portfolios. In that way, doing nothing is actually a sensible course of action. But this optimistic view doesn't account for the inherent fragility of deposits. If a bank as established as Silicon Valley Bank or First Republic can face a lethal tidal wave of withdrawals from accounts that lack deposit insurance, it is clear that a bank can very quickly become unsound. Actually selling those securities or loans at discounted prices turns paper losses into real ones, which can quickly deplete a bank's capital, forcing regulators to step in. That's why this type of bank crisis, a vicious cycle of routes and runs, can be so intraceable. 3 banks have now fallen victim to this dynamic. Investors do have things to worry about with banks. For one, vehicles such as money market funds, which compete with banks for cash, are eager to pass on high interest rates to customers. Customers are eager to take them up to the offer, and banks have to offer comparable pricing if they don't want to risk losing rate-sensitive depositors. Smaller lenders are also contending with the perceived solidity of their big bank peers. The regulatory overhaul in the aftermath of the 2008 financial crisis mostly focused on the risk of mega bank failures. Owing to their global interconnectedness, it worked, making them safer and more appealing to depositors. Everyone else, by extension, appears weaker, Out of the nearly 8 trillion in uninsured US depositors at the end of last year, nearly two-thirds reside in 7 banks with more than 500 billion in assets, according to figures compiled by Vanderbilt Law School professor Morgan Riggs. A potential adjustment to capital rules for regional banks might be playing into the market volatility too. The Wall Street Journal has reported that banks with assets as low as 100 billion might at some point be required to reflect paper losses on certain investments in their regulatory capital levels, something the biggest banks already have to do. Even though those changes could take years to come into effect, analysts might already be marking down banks' capital levels and anticipating capital raises that dilute current holders and reduce future profitability. Even without additional capital, most banks could muddle through this crisis with reduced earnings and financial flexibility, but a razor's edge existence makes them vulnerable to rapid changes in market or customer sentiment. A move to extend insurers to deposits of more than 250,000 limit might calm investors' fears, but this could require a divided Congress to act, all of which makes this such a difficult crisis to resolve. Some in the market have decided that smaller banks need more capital, but share prices have fallen to levels at which it will be much harder to accomplish. If investors want only banks that can't possibly fail, this bank confidence crisis will keep simmering. There you have it, guys. In the following weeks, we might see the fall of Westpac and Western Alliance Bank. So be on the lookout for that. Um, if the Fed decides to back these banks up, um, bail them out, then that's going to have a negative effect on the dollar. We can expect the dollar to fall to about $100, the dollar index, to fall to about $100 if that happens. So be on the lookout for that. Thank you again, guys. Do make sure to like and subscribe.